Namaste and welcome to the concept of cost of capital under Simple Solutions series. We will be getting into the literal meaning of cost of capital. When we say cost of capital, it is cost relating to capital. And when we express it as cost over capital. Capital is nothing but long-term funds, owners' funds and borrowers' funds. And when you express it in more detail, it is cost divided by net worth, which is equity plus retained earnings, preference capital, and long-term loans, which may be term loans or debentures, but they will not include short-term loans under any circumstance. Means when we put these three baskets of equity capital and retained earnings, preference capital, and long-term loans and debentures, we find the concept of cost in respect of each of these is distinct and different, because the cost that a company incurs on equity and retained earnings is dividend. In case of preference share capital, it is dividend and it will be including tax when it is irredeemable preference shares. It is not applicable in respect of redeemable preference shares. There will be redemption premium and also issue expenses, which are also called as floating cost. These are the costs incurred by the company in respect of preference capital. And coming to long-term loans and debentures, the company will be paying interest, but it will have a tax shelter. Therefore, it will be after tax, because to the extent of admissible expenses, the company saves under tax shelter. Therefore, it will be interest after tax. There will be redemption premium. If at all it is there, it will be considered as a part of cost, and also floating cost. This is the cost in respect of long-term loans and debentures. And sometimes it is also indicated debentures are irredeemable, but that is a different issue. But normally they are redeemable. And in addition to these three, sometimes it is always mentioned short-term loans are taken by the company. But short-term loans do not form a part of long-term funds. Therefore, they will not be considered under cost of capital. And that way, what we will find is, in respect of each of these categories, we will have a separate formula for calculation of the cost of capital. Cost of capital in respect of equity and retained earnings is equal to dividend divided by the price paid. In respect of preference capital, it will be preference dividend, redemption value, net proceeds realized divided by duration or life of the debenture. These two will be added. It will be divided by redemption value plus net proceeds divided by 2. This is the average funds received to form an amount of what is the preference capital which is received on an average. Third, when it comes to term loans and debentures, it will be interest post-tax, 1 minus tax. Then same terminology, redemption value, net proceeds of issue divided by life of the instrument. Adding these two at the numerator, denominator will be redemption value plus net proceeds divided by 2, which forms the average capital involved or average long-term loans and debentures. Means for cost of capital, we have components and each component is computed differently using different concepts, and when they are put together in a systematic way, they form the overall cost of capital of the company. Conceptually, it is the minimum rate of return a company must earn. Simply put, you borrow from the bank at the rate of 10%. In that case, that money, when it is used in the company should minimum earn 10%. This is the cost of capital, minimum rate of return, and that is expected by the investors also, because we are supposed to earn money out of the capital that we have brought, earn more than what is supposed to be paid, and that will make ourselves happy and also our investors happy, and there is surplus funds with the company. It goes without saying that when a company makes more than cost of capital, means if you borrow at 10%, your return on investment has to be more than 10%. Then the share price of your company will increase, because your market value is expected to increase, for the simple reason you are making money on borrowings, that is adding to the shareholder wealth. And the cost of capital of a company, as we saw, depends upon the mixture of equity, preference, and term loan and debentures, and it is determined by the mix of it, and the cost of each of the item of the capital mix. And the overall cost of capital of the company is a product of different types of investments and instruments, and it is calculated by assigning weights to each category, and therefore it is known as WACC, which is nothing but weighted average cost of capital, or it is also known as composite or combined cost of capital. This is a brief overview of what is cost of capital and how does it affect. And where is this cost of capital used? In capital budgeting decisions, because when you invest on a long-term project, the project should get you money more than what you pay as its cost. Then capital structure decisions, what is it? How much debt we should have, how much equity we should have. Out of that, how much should be debentures, how much should be preference shares, how much should be long-term loans. This is known as capital structure. Then evaluation of financial performance. The company performs one financial year. We need to understand how was the performance. Did they achieve the target of cost of capital plus something add on? And other financial decisions, dividend payment, capitalization of profits, rights issue proceeds. All these are working on the sentiment of the market. Market always works on the concept of cost of capital of the company and the returns earned by them. Accordingly, they will expect dividends and they will expect rights. They will also expect conversion of reserves and surplus into into shares to be issued as bonus shares to the investors. It is all looking into the anticipation on the part of the investors from the lens of cost of capital and performance of the company. How is the cost of capital computed? It has got two major steps. One, we calculate cost of capital of each source, as we saw, separate formula and separate calculation for debt, then for preference capital, then for equity, and also for retained earnings along with equity, because retained earnings and equity will have similar pattern of working, although the growth and ROI is slightly defined with a difference in respect of retained earnings. Second step is we do the individual working, then calculate the weighted average cost of capital. Only two steps. First step is, as we know, first step, cost of specific sources of capital, debt, preference, equity, and retained earnings. How do we go about? Let's have a look at it. If we list out, normally we will come across equity and retained earnings together, preference shares, debentures or long-term loans, and sometimes it will also be mentioned as short-term loans in the exam problems, but we need to be very careful not to consider it. It is not a component of capital structure. Capital structure is always long-term, and these are the three things. Now, if we have to calculate as the first step the cost of capital, if I take equity and retained earnings, normally there are three formulae. One, when there is no growth projected or the data on growth is not considered, it is simply D1 divided by P, that is dividend divided by the price. There is a model called growth model given by Gordon, known as Gordon growth model, which talks of dividend, price, and also growth in earnings. Third, there is one more method called capital asset pricing model, which talks of risk, normal risk, premium for the market risk, and the extent of risk involved, which is called beta. This is normally the problems that arise. They make use of Gordon's model when growth is given. When it is not given, the no growth model is used. But when specifically R1 and market risk are indicated, we have to use capital asset pricing model. We will get into their details separately. Then comes preference shares. In respect of preference shares, conceptually, and it is theoretically, it can be perpetual, means not redeemable at all, permanent like equity, which will carry fixed dividend, or it may be redeemable after a specific period of time. If it is perpetual, we take dividend and we will also add the dividend tax to be paid, and it is divided by the net realization, net proceeds, or it is nothing but the retail price less flotation costs plus redemption. It is in respect of perpetual. In respect of redeemable preference shares, the logic is simple: dividend, redemption value, net proceeds, duration, and same concept used here to find out the average. And we use invariably the redeemable module for the calculation of value because this is rarely in vogue. Then comes debentures and long-term funds, term loans from institutions or from banks. They can be perpetual. In that case, it will be interest minus tax. That is 1 into tax shelter divided by the price. Or when it is redeemable, the logic is almost similar to redeemable preference shares except for the tax shelter. Interest into 1 minus tax plus RV minus NP divided by N, all put together divided by average of RV plus NP divided by 2. These are the simple formulae which we will just see in their greater details one by one before we get into a practical solution on that. In case of equity, as we saw, no growth. What is D1? D1 is dividend. What is P0? P0 is issue price of share or current market price. This is the dividend cost of capital in respect of equity where no growth is involved. Under Gordon growth model, cost of capital means D1 is dividend, P0 is issue price, and G stands for growth rate. Now we use this formula both for equity and retained earnings. When you use for retained earnings, if specific growth is not given, this growth in respect of retained earnings or retention funds has to be derived based on the ROI. What does it say? Whatever is plowed back, 1 minus payout ratio. If 50% dividend is paid, B equals 1 minus 0.5. Payout ratio, 1 minus payout ratio. Payout is 50%. 0.5 into, if the return on investment expected is say 12%, 12% into 0.5, it becomes 6% becomes the G. Means we have to specifically understand there is a specific significance for G when we are calculating cost of retained earnings. The formula remaining the same, G has to be derived if it is not given by using B into R. B is 1 minus payout ratio, R is return on investment expected by the shareholders. Coming to capital asset model, CAPM invariably they say, and in CAPM R1 is risk-free rate of return. It should get, equity has to get, plus beta of security. It is extent of the security or risk that is involved, and what is the market premium based on the risk. Higher the risk, higher the premium. That will be the way it is worked out. RM minus R1 is nothing but market premium. If RM is separately given, return on market portfolio, we have to just put it as RM minus R1. If RM minus R1 is given as market premium, we can straightaway replace this with market premium. These two are the important formulae, but their logic is very, very simple. Dividend over price with growth, or it is risk premium, risk-free return plus market premium based on the beta of risk. Similarly, we go to preference shares. Preference shares can be perpetual or redeemable. When it is perpetual, there will be a dividend tax which is borne by the company, and therefore what we do is D into 1 plus dividend tax divided by net sale proceeds or issue price minus flotation costs. This is NS. NS, NP are interchangeable. Invariably, it always means net price less flotation costs in either way. If it is redeemable, which is a frequent case, we come across invariably redeemable preference shares, then it is annual preference dividend. It is just defined as D here. It is annual preference dividend plus redemption value, net proceeds or NS after deducting flotation costs divided by N, all divided by average of redemption value plus net proceeds, which is defined here. This is just to give the legend for each of the items in the formula. Coming back to debentures, which can be perpetual or redeemable, you find this is as good as same as the preference dividend, except tax shelter comes into picture in case of debentures. Whenever you pay interest, you get as deductible expense under taxation. Hence we take it after tax so that the impact is less. Here, coming to perpetual, I stands for interest payment, tax for tax rate divided by price, sale price of bond or debenture, less flotation once again. Interest on debentures, current market price is NP, RV is redemption value, N is period of debenture, T is tax rate. It is concept, once it is clear, it is so easy. This is a summary of it. Once again highlighting, short-term loans are not a part of cost of capital, and this is a summary of the 3 plus 2 plus 2, 7 formulae, of which this is rarely used. This is rarely used. This is also rarely used. Invariably, if you find here now, these two, rest of the components are the same. Have a look at this. Here it is preference dividend. Here it is interest into tax shelter. That otherwise the formula is the same. And here it is Gordon growth formula as well as the beta and risk-free return and market premium. And short-term loans not a part of capital structure. Having understood this, we have calculated it concept-wise. We said there are two steps in calculating cost of capital. Second step is computation of weighted average cost of capital. This is a simple tabular multiplication. Just like, for example, you have got book value. Debentures of 100 each, 8 lakhs is there. Preference shares 2 lakhs is there. Equity shares is 10 lakhs is there. WACC is computed by using market value or book value. And the moment we do the book value, what we do is we calculate weight. What is calculation of weight? It is converting the amount into percentages. If 20 lakhs is equal to 1, 10 lakhs is 0.5, preference shares 2 lakhs is 0.1 and it is 0.5. That is 40%, 10%, 50%. This is the weight. Weighted means these weights are calculated. Then we can use the market value also. They will always indicate debentures are of the face value of 100, but their market price is 110. Okay, if 100 is 8 lakh, 110 will become 8 lakh 80,000. Similarly, preference shares 100, but market price 120. At 100 we have 2 lakhs. At a premium of 20%, it becomes 2 lakh 40,000. Then equity shares have got a market price of 22. Here we have taken book value of 10. 22 when it becomes 22 lakhs. We calculate the total. This is the total of market value. We calculate the weight. If 33.2 lakhs is 100%, equity 22 becomes 66.3, preference becomes 7.2%, and debentures becomes 26.5%. Totally, it becomes 100%. Therefore, weighted average based on weights based on book value is derived, weights based on market value is derived. And to this, the cost of each individual source of capital, debenture has got a separate cost, preference shares has got a separate cost, equity shares has got a separate cost. Each weight is multiplied by the respective costs. Let us look into. How does it work? It says for equity, take the weight, take the cost, multiply. For debentures, take the weight, take the cost and multiply. Add it together. Weight, cost of preference and weight, cost of retained earnings. This is the formula of weighted average cost of capital. And it's simply given here, equity reserves, debt and preference shares, explaining this mathematical expression of it. And we have seen there are market value as well as book value. What people prefer are market value based things, because all these are keeping investors in mind. Investors are always guided by the market price. Although book value is not ignored, but what is predominant is the market value as an index of company's valuation. That way, we have prepared the weights, we apply the cost of capital. Supposing we have calculated it as 7%, preference shares our cost is 14% and 17% in case of equity shares, and we get it. We multiply A into B, which is, this is W, this is cost of capital, weighted average cost of capital A into B, 2.82, means 40% of capital is at 7%, 10% of capital is at 15%, 50% of capital is paying cost of capital of 17%. Therefore, our average cost of capital WACC for the company as a whole is summation of this, multiply here, total here, it comes to 12.8. If you go by market value, it goes up to 14.1. You know why? Simple. Take here now. This is the cheapest cost. What percentage of capital is paying? 40% is at 7%. But here 7%, what is the percentage? 26. Cheap funds have smaller exposure. Take the highest one, 17%. We were paying 17% on 50% of our capital. 17 into 0.5. Here 17 is not 0.5. It has gone up to 66%. Therefore, it has moved from 8.5% to 11. Hence, the increase in cost of capital. It makes a difference. The weights make a difference. Now, this is all theory which we have seen. Let us take a practical problem and find out how do we sort it out. Determine the weighted average cost of capital using book value, market value. Book value is given here. We will use in the tabulation of book value. Recent market price of all these securities is given as debenture 110, preference 120, equity. This will be used for market value. Both will come at the end of the problem. External financing opportunities are, we have got debentures, we have got preference shares, and we have got equity. We know how to work on them. Let us take each one of them. First, debentures. Now, what is the formula for debenture? Debenture is 1 minus tax into interest multiplied by redemption value minus net price realized divided by n, and then the formula. Let us just see how does it work. 100 per debenture redeemable at par, redemption price will be 100. And 10-year maturity, n means 10 years. 13% coupon means 13% is the interest. 4% flotation cost means F is 4%. It will be deducted out of NP. And sale price is 100. Net price is 100. We put the formula here. Cost of capital equals interest. What is interest? 13%. 1 minus tax rate. Where is the tax rate? Tax rate is 50%. Where did we get it? It is given here. Corporate tax is 50%. We will see it. 0.5. Then RV is 100. We put RV as 100. NP minus flotation, we have to take net of it. 100 minus 4 is 96. N, duration is 10. Put 10 here. And RV, 100, 96. Instead of minus, you plus here to get the average investments. To simplify, 13 into 1 minus 0.5 is 0.5. 100 minus 96 is 4. Divided by 10 equals 0.4. 13 into 0.5 is 6.5 plus 0.4 is 6.9 divided by 98. If we look into 6.9 divided by 98 into 100 is equal to 7.04%. This is the cost of debt. The way we have worked out is simple and clear. Understanding the formula and substituting the values in the formula. Similarly, second one, we have got preference shares, and in the previous thing, corporate tax we had taken from here. It was hidden in the working exercise. Preference, what is given? Maturity is given, dividend is given, floating cost is given, sale price is given. Means it is redeemable. We have to use this formula. PD plus RV minus NP divided by N divided by RV plus NP divided by 2. Simple. Preference redeemable at par, rupees 100 is the redemption, at par, 10-year maturity, N is 10 years, 14% dividend, 14, 5% flotation costs, and sale price, net price is 100. And we apply annual preference dividend is 14, redemption value is 100, net price minus flotation 100 minus 5 is 95, duration is 10 years, divided by 100 plus 95 into 2, and that brings us to 14 plus 100 minus 95, 5 by 10 is half, divided by 195 divided by 2 is 97.5, effectively 14.5 divided by 97.5 into 100, the cost is 14.87% in respect of preference shares. Debt over, preference shares over. Now we come to equity shares. For equity, what is given? We have to see which formula is applicable. Here once again it is talking of dividend rate is given, sale price 22 is given, and dividend for the year is 2, growth rate is given as 7%, and flotation cost, growth rate year as per cost price 22 dividend expected, and flotation is rupees 2. Now we apply this formula. Annual dividend 2, net price less flotation 22 minus 2 is 20 into 100, plus G is 7%, 20, 2 divided by 20 into 100 is 10, 10 plus 7 is 17. Equity shares valuation is simple and straight, it is 17%. Thus we have seen now our debt is at 7.4%, preference is at 14.87, and equity shares at 17%. Now that brings us to the last part of it, market value and cost, book value for the sake of valuation. We take the book value 8 lakhs, 2 lakhs, we repeat this table. Then we find they have given debentures of 100 each at 110, preference shares at 120, and equity shares at 22. Multiply and revise the values. 8 lakh divided by 100 into 110, 2 lakh divided by 100 into 120, 10 lakhs divided by 10 into 22, and now we calculate the weight here, 50, 10, 40%. Similarly, we calculate the weight here, and we know the cost of capital in respect of each component. We post these three costs, 704, 1487, 17. One thing you have to remember, whether it is book value or market value, cost remains the same under both approaches. We post both costs. On our weighted average cost of capital is A into B. We get it here, 12.8%, 14.21%. That is the solution to the problem. Congratulations. Thank you so much. Thanks a lot.